guys. So, as we all know, the Fed has been going absolutely gangbusters with monetary stimulus. And if you listen to Peter Schiff, you'll know that this monetary stimulus is really just inflation. That's all it is, inflation. That's why assets like gold, copper, precious metals, any real hard asset, Bitcoin, all of those have been going through the roof lately. We look at M1 money supply. This is the closest thing to a measure of money circulating in the US economy as we have. M1 money supply absolutely skyrocketing from COVID. All right, go to M2 money supply. Right, this is a little bit of a broader view of money supply floating around in the economy compared to just M1. So M2, right, 15.5 before COVID, 19 after. We go to M1, right, again, this is a little bit of a more filtered view. 4 before, 6.5 after. Now, what does this mean for assets like long-term treasuries, the value of the US dollar, and yield curve spreads, right? So what's the yield curve spread? The yield curve spread is essentially the difference in interest rates on different dated maturities of debt instruments from the US government, right? From the Treasury. So this right here is coming straight from the FRED, Federal Reserve Bank of St. Louis, right? So this shows you over time the difference between interest rates on 30-year notes, 30-year bills, and 3-month bills, right? So the higher this spread is, really the more normal the condition, right? Because a longer dated debt instrument, the interest rate should be much higher on a longer dated debt instrument than a short dated debt instrument. If you loan money to someone for 3 months, and they're paying you back, the risk of you losing your money is much smaller than if you loan money to someone for 30 years. So if you loan money to someone for 30 years, then you're going to make them pay you a higher interest rate on that loan. And so this higher spread is the normal state of the economy, right? But when we get into these, and this is where you hear the inverted yield curve discussion time after time, this inverted yield curve precedes a recession, right? These gray bars right here, they're recessions. And the reason this is such a powerful indicator, and you can ignore anyone on CNBC, anyone who says this is not a recession indicator, you can ignore it every single time, because you know that this is a logical fallacy. This does not make any sense, right? 30-year loans having the same interest rate as a 3-month loan. That's basically saying that we're evaluating the risk of default on a 30-year loan the same as we would the risk on a 3-month loan from the US government. It makes no sense. How does this happen? Well, it's market manipulation by the Federal Reserve. Things like Operation Twist, things like the so-called expansion of the money supply, right? So what happens as this yield curve flattens? That's what they call it, right? It's a flattening of the yield curve. What happens? Well, debt instruments are sensitive to these, right? So if I'm holding a 30-year bond, let's say with interest rate of, in June 2007, with interest rate of 0.593. If a few months later the new interest rate on a 30-year bond is 3%, well, the value of my bond with interest rate of only 0.59 is much lower because investors can get a much higher interest rate. So the value of the bond that I'm holding goes down. The price of the bond that I'm holding goes down. It's no longer as valuable because it's paying a lower interest rate than the going market rate. The opposite is true when yields are falling. So if in December of 2013 I'm holding a long-term dated treasury at 3.82%, and years later that same debt instrument is only paying 1.56%, well, the value of whatever I was holding is much higher because it has a much higher yield. So that's how we can forecast what is going to happen to assets like TLT. This is the iShares long-term treasury bond index, right? Well, this thing was on a tear. This thing was on an absolute bull run, right? From Q1 of 2011 all the way, right? All the way until basically COVID hit. So what do we see in this 30-year spread? Well, oh, what do you know? Peak in 2011. Right, this thing is falling ever since 2011 all the way down to 0 in August of 2019. So this is when the bull run started, Q1 of 2011, right at the peak of this yield spread. And as it's following, right, okay, so let's see, June 2012 to September 2013, it goes back up. So June 2012, right, June 2012 to August 2013, you see it dips here. These are highly correlated, TLT and the yield curve, the Federal Reserve interest rate yield curve. Well, really the US Treasury yield curve. This is one method you can use to play the market, right? We know that right now yield curves are steepening. You see this time and time again, right? After it hits 0, shoots back up. 0, shoots back up. 0, shoots back up. Now, one thing to keep in mind is that the Fed is considering yield curve control to prevent this spread from rising too much. That's the current state of affairs right now. And you see this starting to raise up, but it's starting to flatten out a bit. But here's the difference. There's only so much room to fall. It can't fall much further than below 0. So right now we're in this, 1 to 2% range. We know historically the spread peaks somewhere in the 4 to 5% range. So right now, things like TLT are a bad investment. Long-term treasuries are a bad investment because really the only place for this spread to go is up. I mean, yeah, it might go back down a little bit. It might go back down to 0, but those gains are going to be very small. You want to wait until this goes back up into the 4 to 5% range before going into assets like TLT. Once it happens, once that 4 to 5% spread hits on this, oh, it's go time, baby. It's go time. You're going to see huge gains. But right now, long dated treasuries are a terrible investment. There's really nowhere for them to go but down. And so that's why you hear a lot of people talking about gold, Bitcoin, because because of all the monetary stimulus, because of all the monetary expansion and the devaluation of the dollar. Right, so what's happening with the dollar because of this increase in M1 and M2 money supply? And keep in mind that Japan, the euro, the Japan yen, the euro, all of these countries are also doing the same thing as the US Fed. They're expanding their money supply, they're printing money. But what's the difference? The US is the head of the global monetary system. The US dollar is the global reserve currency. And like Peter Schiff says, the US dollar has the most to lose. So in light of that, the US dollar stands to lose the most from an expansion of money supply, because what is really the value of the US dollar? It is a measure of trust, right? Everything comes down to supply and demand for currency in economics, right? It's simple. Supply and demand. The higher the demand, the smaller the supply of anything, the higher the price. Same thing with currencies. When the trust goes down, basically the demand for that currency goes down. So if global trust, if international trust in the US goes down, the value of the US dollar goes down. And that's why the US dollar is seen as a safe haven, because it has been the stronghold since Bretton Woods of currency security. And that's why right after COVID, you see all this money flowing into the US dollar. Right after COVID, the US dollar plunges a little bit and then it spikes all the way back up. Ever since then, it's been on a free fall, an absolute free fall. Why? Because of the expansion of the money supply. People are realizing that the US government cannot fund its debt at higher interest rates. And that's why we're hearing about yield curve control, because the US government cannot fund this debt at a higher interest rate. It cannot. So the value of the dollar is plunging. It's going to continue to plunge. This is the chart over the past 3 years. But if we go to, further back, what do we see? Right now, we're actually relatively high compared to after the financial crisis, after GFC, global financial crisis, right? So this is the dot-com bubble, right? 2000, 2001. This was right during the dot-com bubble. Boom. Tank. All the way down to 72. Global financial crisis hits. Again, similar thing with COVID. Everyone's flowing into the dollar as a safe haven. It spikes back up, temporarily goes back down, kind of bottoms out and just stays low. But what we're going to see is a continued decline in the value of the US dollar. This is going to go back down into the 80s, go back down into the 70s. You look at this chart, there's really no comparison into the increase. This little blip right here, this tiny little blip is the expansion of the money supply from the GFC, from the global financial crisis. That's the monetary stimulus and the fiscal stimulus from Obama. Tiny little increase. Tiny. What happened now? Oh, the value of the dollar is going down, and that's why it's important right now to be invested in gold, in silver, and copper, even a little bit in Bitcoin. Bitcoin's a little bit more of a risky investment. I don't believe in the inherent value of Bitcoin as much of something tangible. Now, the technology of blockchain is always going to be valuable. And that's why I think it's worth investing a small portion of your portfolio. But all of this expansion of the money supply is why we're seeing growth stocks go through the roof. Things like ETFs like ARK, FANG stocks go through the roof, because money is getting plowed into the stock market, and money is getting plowed into these high growth, high momentum stocks. So anyway, that's all I have to say about the Fed and yield curves. Hope you guys find it helpful. Later.